Hi, my name is Scott Bernard. I am a fixed income portfolio manager here at Westwood Group. We wanted to take a little time today to talk about the national debt. We wanted to explore what the national debt is, why our country borrows so much money, to whom we owe it all. We'll also examine the impact of the government debt on the economy and answer some commonly asked questions about the national debt. First off, I wanted to talk a little bit about the difference between the deficit and the debt. Perhaps because these two terms sound so much alike, many people confuse the government's deficit with the government debt, but the two are very different. The deficit is the gap between the government's revenues and spending for a given calendar year. If the government were to spend less than the revenues, then we would have a surplus. The debt represents the accumulated deficits over many years and rises when the government runs a deficit and falls when the government runs a surplus. This graph here shows some historical data on the government's debt, measured as a percentage of GDP. The line indicates the part of the government debt that's held by the public, typically in the form of treasury bills, treasury notes, or treasury bonds. After hitting a high of more than 100% of GDP during World War II, debt generally declined as a percentage of GDP until about 1980. In 1980, it started to rise and rose until the mid 90s when we actually ran a surplus in the mid to late 90s, and therefore the debt declined relative to GDP until about year 2000. Since the year 2000, the debt has risen with particularly sharp increases following the 2008 financial crisis, as well as the COVID pandemic in 2020, which we all recently lived through. Deficit financing has actually been a big part of the US government from the very beginning. If we go all the way back to 1776, Continental Congress put the country in debt in order to fight for its independence from Great Britain. As is done today, Congress issued bonds in order to finance the country's war effort. There was considerable controversy even back then regarding the government's role in absorbing the debts of the individual states. Alexander Hamilton, who was the first Secretary of Treasury, was a big proponent of national debt and believed that by introducing greater flexibility into the money supply, it could strengthen the economy and the country. The United States generally repaid its debt fairly quickly in the early part of our history, although wars depleted the government's finances multiple times throughout the 19th and early 20th century. The budget deficits of World War I pushed the national debt beyond 40% of GDP. And then, in terms of government finances, the Great Depression of the 1930s was truly a watershed moment. The economic crisis led to FDR's New Deal social programs, and from that point on, federal spending on social programs has figured prominently in the total debt figures. As we can see in this chart, the government has run a surplus in only 14 of the prior 94 years and is projected to continue to run a deficit in the future. I'd be remiss if we didn't also talk about the role of debt and the US dollar in the global financial markets. US dollar is the dominant currency in the world ever since replacing the British pound as the global reserve currency. This status affords the US government significant privileges with regards to the amount of debt they are able to issue. There's ample demand for the US dollar denominated assets, and the US dollar plays an outsized role in international trade relative to the US share of global GDP. There's widespread confidence in the US dollar as a store of value, and the US dollar comprises approximately 60% of all global foreign reserves. The bulk of these reserves are held in the form of US Treasury securities, which keeps them in high demand from both official and private foreign investors. Over the longer horizon, there is a risk of a challenge to the dollar's international status. One could potentially come from the Eurozone. Increased European integration is one possible source of challenge. During the COVID pandemic, the EU contemplated issuing jointly backed debt. If this market develops and grows, it could make the euro more attractive as a reserve currency. Another source of challenges to the US dollar could be the continued rapid growth of China. Although Chinese GDP has been growing relative to US GDP, there remain significant roadblocks to more widespread use of the Chinese renminbi. Importantly, it's not freely exchangeable. The Chinese capital account is not open, meaning that it's very difficult for companies and individuals to move money in or out of the country, and there remains a lack of confidence in the Chinese institutions. These factors make it relatively unattractive for international investors. So while these risks should not be ignored, we do believe that the US dollar will continue to maintain its status as the reserve currency. Now that we've talked a little bit about the size of the debt, let's discuss a little bit more about the impact on the economy of government debt. One commonly expressed view is that it is a burden on future generations. There's some truth to this assertion, but it's also somewhat misleading. It implicitly compares the government's debt to the debt of a private citizen. And certainly, if you or I accumulated huge debt burden, that would not be good for our future. But government debt is different in some very important ways. First, about half the debt is held by the US public and owned by US citizens. From their point of view, this is an asset, it's a form of wealth. These assets are largely considered one of the safest assets that somebody can own. Second, government debt does not need to be paid off. And this may sound controversial, but provided that the size of the debt does not grow too quickly and the government's credit is viewed as stable, there's always going to be people interested in buying and holding government bonds. This allows the government to roll over their obligations by issuing new bonds to replace maturing bonds. Therefore, the annual cost is more related to the interest owed on the outstanding debt as opposed to the repayment of principal. And third, the US government pays its interest in US dollars. It's much easier to manage your debt if it's denominated in your own currency, as opposed to other countries that sometimes borrow in foreign currencies, and therefore it's much easier to be forced into default due to fluctuations in currency values. This should not encourage us to believe that government debt is never a concern, as rising debt can create significant problems. Interest must be paid on the debt, and depending on the level of interest rates in the future, this means that it will likely be a growing share of future budgets devoted to paying interest. As we can see in this chart, despite the fact that the US debt burden has grown significantly, the percentage of GDP that has gone towards interest payments has actually declined. This is a function of the steadily declining interest rates over the last 30 to 40 years. It's really quite stunning. The level of debt has roughly doubled since the mid-80s, but the annual cost of servicing this debt has been cut in half. We can see just recently towards the right-hand side of this chart, the line has begun to tick up, reflecting the combination of even higher debt levels and higher interest rates as a result of the Federal Reserve's rate hiking cycle. The Congressional Budget Office releases 10-year forecasts each year that include economic projections based on the current budget and laws. The latest forecast suggests that interest payments as a percentage of GDP will grow both due to higher debt loads and higher interest rates, especially when compared to the 2010 to 2020 time period. This is a potentially discouraging trend and is perhaps much more worrisome than the overall level of debt on its own. Another concern with mounting debt is that if the debt burden becomes significantly large, lenders may start to doubt the borrower's ability to repay. If the doubt were severe and widespread, it could affect the bond market and, as a result, the national economy. Risk-averse investors would likely sell their bonds, pushing bond prices down. And when bond prices go down, bond yields go up. And therefore, any new bonds issued will have to match this higher yield, meaning the government will have to pay even more interest costs in the future. US government bonds are widely viewed as some of the safest assets in the world, and they're often referred to as having zero default risk. This means that investors expect the chances that you will not receive your interest payments as well as your principal at maturity is effectively zero. If doubts begin to seep in on this assumption, it could be very impactful. It would have implications for all parts of the financial markets, as we often assess the value of other types of debt, such as corporate bonds, relative to the yield on US government debt, also known as the risk-free rate. If this were to change, the implications are massive for both the country and all financial markets. In the summer of 2011, Standard & Poor's, which is one of the major rating agencies, downgraded US government debt from AAA to AA+ as a result of the political impasse over the debt ceiling and the inability of Congress and the White House to reach an agreement. Debt ceiling deadlines have since become an issue every few years, but have generally been resolved without crisis, perhaps because the memory of 2011 is still fresh. We will be discussing the debt ceiling and related topics in more detail in an additional video later this year, as we expect it will become even more topical as the deadline approaches. Thank you for your time today, and we'll talk to you in the future.